out because you can get loans for 1.0, less than 1, 1.2, all these things, and that changes your leverage. So knowing how to use long-term finance is going to be pretty important to grow your wealth and invest in real estate. My name is Alex BRRRR, and this is The Drive, where I tell you tips, strategies, and ways to execute to grow your business, keep you out of trouble. All right, so today we're going to talk about 30-year asset-based lending. You guys have probably heard it, multiple things like non-QM, DSCR, low doc, whatever it is, what you're doing. It is a 30-year product that you can use when you are refinancing or purchasing investment real estate. So let me go through what it is and how to use it. All right, so just like any loan, first you got three options. You have option number one, you're going to use this to purchase. You're going to use this to, option number two is you're going to use this to refinance. Option number three, you're going to use this to cash out refinance. Basically refinancing, but you get more money back. Okay? So, option number one, DSCR 30-year product for purchase. Now, this is going to be a really easy way to get your purchases done in a short amount of time using the asset as the basis. But just like any DSCR loan, it goes off the ratio. All right, so what is that ratio? The ratio is called the debt service coverage ratio, and what it is if your principal, interest, taxes, insurance, and association dues, which is your whole monthly payment, is $1,000 a month, for a 1.2% ratio, that means you'd have to rent for $1,200 a month. So the asset stabilizes itself 100% plus 20. So 20% over the payment is a 1.2 ratio. $1,300 would be a 1.3. $1,400 would be a 1.4. The higher the ratio, the safer the deal, the lower the rate. So when you're using this for purchases, you got to look how that stabilizes out, because you can get loans for 1.0, less than 1, 1.2, all these things, and that changes your leverage. So the 30-year product is a little more complex in its term. Okay, so when you guys are terming these out, you have to understand this is all based off of value and rent and taxes and insurance, all these things. So until you get firm finals of all those numbers, know that the term sheet can shift no matter who you use. All right, so when you're buying them, most of the money today tops out at 80% of purchase price or as is value, whatever is less of on a purchase. So that means minimum you're coming out of pocket 20% on a purchase. Okay, if you use 30-year as the purchase. So, and I'll tell you a little strategy at the end to show you how to do it $0 out of pocket. But you have to prepare for that. So if you're buying a property, it has no maintenance, no repairs needed. Like say it's occupied, you're buying it from a distressed investor, or it's just on the market, and you just need to be prepared that if you use the DSCR product as purchase, you're going to come out of pocket probably by 20%. On the refinance, see, the refinance, and this is where that strategy comes in on refinance and cash out refinance, is your top loan to value on DSCR today, which is October 2nd of 2025. I've seen this not really shift much over the last 6 years, is 75% loan to value on a refinance. Okay, what that means is you're in a hard money loan, or you already own the property. So you're not buying it, you're refinancing. So that gives you 75%. And then you're going to be like, Alex, if I purchase it at 80, I'm getting more money. Not necessarily. So the refinance is based off the current value of the property, not what you bought it for. Okay, so a lot of you guys are refinancing from like a hard money loan where you put repairs in. So that 75% is based off the value, and any DSCR lender is going to be like the appraisal is basically gospel, all right, on value. So if you get a good value, you'll get 75% of that. For instance, for easy math purposes, if the value was $200,000, well, 70% is 140, and I'm driving, so I'm trying to do math in my head. So let's see, that'd be 150. All right, so so if you had a balance at 70% from your hard money lender at 140, and now you can be lent 150, you can actually roll in your costs, and that doesn't count as a cash out. Okay, so that is a strategy that I help investors use with our DSCR paper, is to try to minimize the out-of-pocket cost on the refinance when you are refinancing out of a hard money loan. Okay, so that is how you can do a refinance with a DSCR loan. And again, it's still heavily based off the value of the property, the rent, the taxes, the insurance, all those things. To do a cash out refinance, it's the same thing as a refinance, but the margin that you have is spread. So let's say same scenario, let's say we're lending 150 at closing on a cash out refinance, and you owe 80 or you owe nothing. I can lend you up to 75% of that value cash out. All right, this is where people look at, and I go like, Alex, why would I do that? Well, if you're getting a rate at like 6.5, your cash out money is at 6.5 cost of capital. I mean, if you guys are looking at credit cards today, you're in the high 20s, low 30 APR, and now you're getting money at 6.5 or 6 or 7, and you're putting into assets that are generating 20%. And so annualized, your first year return is whatever, 20% minus 7, so you're 13% annualized year 1, and now you have a new appreciating asset. That's why people do it. All right, so that is 3 ways you can use DSCR lending to refinance your property. You could also use it as a secondary exit strategy. So when you are a flipper and you are noticing your property cannot sell, or cannot sell for the amount of money that is needed to obtain a profit, refinance it. Rent it, wait till your market stabilizes, wait for the appreciation spread, then sell it again as a midterm play. So it's also to help get you out of high interest loans and work on exit strategies that afford you better returns later, while maybe putting a renter in it or something like that, where you may cash flow or not, but you're stopping the hemorrhaging at like a 13% loan, and you are now making a little bit of cash or netting 0, but you're not hemorrhaging your liquidity anymore. So it's a safety net product too for exit strategies. Here's a couple things you need to know before you jump into DSCR lending, if you are in that market where you're listing your property. Key variable, okay? If you have listed your property, and let's say, I think it's worth $600,000, okay? And you listed it, and now you've dropped the price over and over again, and now it's listed for $520 and it's not selling. If the appraisal comes in at $600, 620, $400 million, it doesn't matter, and you have it listed for 520, make sure you guys understand this. With any lender you use, hopefully it's us, but because we'll tell you this stuff, you will not get any more leverage than the listing price that you have it currently listed. So if you have a high, like 600, 700 ARV on that example, or that value off the appraisal, you have it listed for 520, you're getting 75% of the 520, not the 600 of the appraised value. One of the things you can do is with certain lines, and we have these lines, we check with your lender because not everybody does, is that you can remove the listing completely, and that will negate that issue, okay? But you have to do it prior to ordering the appraisal, so it's a risk. It's a risk that you have to take. But if you already have, I mean, my advice is this, it doesn't mean I'm right or wrong, but if you're already, can't sell the property, and you're not getting any showings, or you're just getting a bunch of showings and no offers, what's the hurt? That, you unlist the property during this process, and let's say you don't decide to go through it, okay, relist it. All right, well, you lost what, a month of not selling it? You weren't selling it anyway, but you had the opportunity to cut your interest rates in half, possibly cash out, and things like that. So again, it's capital stack strategy. A lot of people spend time learning how to buy properties and get their renovation, but they never learn capital stacking, they never learn financing, they never learn how to restructure their debt to make themselves in a better position. All right, so that's just watch out, number one. Okay, another thing to watch out for when you're doing DSCR lending, when you're getting terms and quotes and things like that. All right, make sure that you know this. That first term sheet is not what it's going to be like, okay, unless every single dollar, credit score, experience, all these things are exactly the way you told your loan officer, okay? Because again, these are all off of ratios. So if you're like, oh, I'm renting it for $1,200 and the taxes are like $3,000 a year and the insurance is like $3,000 a year, and he comes back and the taxes are $5,263 and the insurance is really $9,000, that's all going to shift everything. All right, so I'm not saying that I want you to be apprehensive about giving ballpark numbers. You just, as the borrower, know that when real numbers come back in, it's going to shift everything. Okay, so get with a team that kind of guides you through it, because DSCR lending isn't hard. Okay, what's hard about it is people not explaining things to the borrower appropriately and the expectations of it, because you're so used to hard money lending for your short term, being like, well, we closed in 7 days, and that ain't DSCR lending. Don't let anybody tell you that it is. It's not. All this capital, and I can't say all, I hate saying all, but most of the capital that comes for 30-year lending comes basically from almost the 5 or 6 same places, and then they create lines with lenders like us. We help originate it, they take it, they securitize it and dump it into securities. If you guys even have your own personal residence, how many times has your note been sold? It's the same thing, okay? They just know the safety in investment paper because the property is being paid for by the tenant. So they like that. They very much like that paper. So they're willing to lower their doc requirements, lower this, lower that, everything like that. So get with a team that can really work out DSCR lending, understanding there's going to be issues along the way, and a team that understands the product enough to know how to place you and know how to fix those issues and know how to make things work, because DSCR lending is not like short-term lending, okay? There's a lot of things that are going to come out in underwriting when the appraisal comes back in, and there's going to be you have to have a knowledgeable team to know how to structure everything, okay, and know how to kind of drive that ship to closing. Because you guys remember, In short-term and long-term lending, the underwriter's job is to find out reasons why not to do the loan. So you got to have a loan officer, and you got to have a team that can really, really make good arguments and points for the safety of your loan, no matter how you're situated. Okay, so that's DSCR lending in a nutshell. It's not everything, but it's going to be a good start for you to know. Direct message me, share this for someone who needs to know. Like, comment, subscribe to the pages. Okay, if you need a video made for something for you, comment below and I'll actually make it for you. Okay, and give you my honest opinion on how you can be successful in any market. We'll talk to you later, guys.